Right.
Hey everybody, it's Eric. Sunday night, March the 12th. Forgive my voice, a little nasally from I think catching a bug in the north. I was in Toronto last week at the PDAC conference and then New York City up until yesterday night. But in any event, I wanted to comment. There's a lot going on. There's a lot going on in the markets this week. I'm sure there will be, just due to the activity last week in the banking system. And I just wanted to address this for subscribers and talk a little bit about a couple of highlights. And I think, the reality is that a lot of people do not really understand the banking system, the fractional reserve nature of the banking system. Our central banking system, which prints money out of thin air. It's why a lot of us are gold investors, and also from there, crypto and Bitcoin as well. But I wanted to talk a little bit about the miners, what I see coming technically, and how this could all play out. Just speculation on my part. I've been absorbing a lot of information over the weekend, and I wanted to highlight, just something that I think would be of interest to everybody, which is the FDIC, their website, their annual report. And we're going to take a look at, just the examples of, what we actually have for backup insurance in the banking sector. There are a lot of people that are asking the federal government to back all depositors' money at Silicon Valley Bank, which was just shuttered on Friday and was taken over by the FDIC. This is the second largest bank failure in history in the United States after Washington Mutual. And it's a big one. It's definitely a big one. We saw Silvergate Bank be, villainized for being a crypto bank. Silicon Valley, they say that they've provided financing for over half of America's startups in tech. That's incredible. And they were an over $200 billion asset bank. And from what I've understood, over 90% of the deposits are over that $250,000 number, meaning a lot of institutional and a lot of corporate clientele that are not going to be able to meet their payroll next week, perhaps. And that's a problem. It's a big problem. So we also have the system, the US insurance and government systems backing the banking sector. They're going to be tested this week, and how they respond is going to be very, very important for our economy, our markets especially, and we'll see what happens. But I think there are some real positives out of this occurring now, and some of those would be, for example, I'll give you one right now, which is that it's going to be very hard for the Fed to raise rates later this month if we've got a crumbling banking sector and there are holes in that banking sector. It's going to be tough, and it might be the tipping point of forcing the Fed to take a neutral stance and eventually begin a pivot and going into cutting rates. It depends how bad it gets, obviously, but even with just what's occurred already, I think 2 weeks is like an eternity in the financial markets, but people are going to be very wary of the Fed getting aggressive on rate cuts, because you could argue that, their cycle here is what's choking out some of these banks. And the problem is that, this isn't just a crypto or tech issue. There are banks, community banks and regional banks across the country that are undercapitalized and could be exposed in the coming days and weeks and months if they don't shore this up and fast. And as an aside, this could be a real delicate place to balance for the regulators in Washington as it pertains to crypto. They've been vilifying it and they've been coming after it hard. And when you have Silvergate blow up, which is really a primary crypto bank, that's one thing. Silicon Valley Bank was very big, and it's also very, very broad in terms of the clientele that they have. And even though it is focused on the tech industry, this is where all of our innovation occurs in the country. And you cannot suffocate that. That is a big, big problem and a bad precedent to set. But then if you have other banks that if they don't cover all the depositors' cash and it's still confidence immediately, you could see a domino effect, because I'll show you right now. I'm just going to show you with the FDIC. The whole system is a charade scam that, you look on the surface and you say, oh, US government's going to take care of any of these banks that fail and give me my money back, or up to at least 250 grand. Well, let's just take a look. I want to share my screen, and let's see here. Okay, share. Let's go to the FDIC balance sheet. This is an annual report of the FDIC. It's just notable because I'm going to see if I do have anything open. Nope, that's not it. About the size of Silicon Valley Bank, which is a little over 200 billion in customer assets. Okay, we know that. I can pull something up, but you can do your own homework and check it. I just saw those numbers before this, probably on my other computer. But we're going to look at this PDF format, and I am just going to go to the summary results or financial highlights. Let's go to that. Hopefully you will see the FDIC.gov page come up, even though it is a PDF. I think you are. And let's look at, this is actually better than I expected. I think that about a decade ago, there were, well, or after the 2009 crisis, there was less than $1 billion in the FDIC deposit insurance fund. And so I was assuming that we were probably 20 to 50 billion maximum, but they've recouped. The DIF balance was 128 billion at December 31, 2022. So, call it 125, 130 billion dollars, whatever. You call it 150 if you want, even though it's not there. This is what the finances look like of the Federal Deposit Insurance Corporation. Okay, this is a situation where I do want to find it on Silicon Valley Bank. I just want to show you the customer assets is a number that is over 209. It's 209 billion, and we'll pull that up in a second. But when you go down to the balance sheet of the FDIC, this is where there's another problem. But if it's 209 billion that is at Silicon Valley Bank, which this is just an ABC News piece, but it was the first one that I saw. And let's see if they list it. I saw it in the summary. Should be, yeah. So at the time of his failure, it was based in Santa Clara, had 209 billion in total assets. So if they wanted to cover all of the assets in Silicon Valley Bank instead of up to 250,000, which is like just 10% of that, so 20 billion. And they claw back a lot of that because they weren't necessarily insolvent. It was a bank run. It's kind of like a self-fulfilling prophecy with these situations. And I don't think their balance sheet was that bad compared to some of these different banks that are out there from what I've seen. But I'm not a banking expert. It's not my sector. It's not where I look to invest or short opportunities. But the issue here is that you've got an insurance fund balance at year end. So let's just go back 2 months and change to 128 billion. It doesn't even cover the total amounts at Silicon Valley Bank, although they have assets and things. So it's not a net type of a comparison, but this is just to give us a feel of the fact that, that's one bank out of 4,500 that are FDIC insured in the country. If you start to see a bit of a domino effect, even a handful, pretty much bankrupt the FDIC, and they're in a pretty decent position from what I've seen before, where after 2009, again, they were down on fumes. This has been replenished. They charge other member banks fees and do other things to generate fees. But you also have total assets of problem institutions. I find is very interesting, 163 trillion. Are those assets or are those liabilities? Those are like toxic assets. I guess they are assets. They're listed as assets, but there's a lot of shit in there, I'm sure. So, it's very interesting that we have so much confidence in an entity that is, not even able to one for one match the assets in a bank that just collapsed last week that they took over. They don't have to do that anyway, because like I said, you do have assets there. It's not like, these guys stole all the money or, they don't have, they're upside down with liabilities, but, they're taken over, they're done. And the FDIC is now in control. They will open the bank up on Monday like it never closed if you have less than 250 grand. If you have more than that, you're in trouble. And imagine these companies that have 1 million or 2 million payroll to meet, this week. What are they going to do? So I think it's a big mystery there, and this is all a very good reason for you and I to own physical gold and protect our wealth. Because what happens if they replenish the fund and they just create the money out of thin air? That's taking our money. It's from us. They don't have, the federal government doesn't have any capital or income unless it's from taxing the citizens. And so we're paying for it one way or the other. So be careful, watch out. I did see some, one of the things that disturbed me was a look at the non-tangible asset investments, the actual unrealized losses on bond portfolios of some of the brokers and banks. The one that stuck out the most was Charles Schwab was at the top of the list. So those of you that have Charles Schwab accounts, I'm not saying you need to pull your money tomorrow, but you might want to pull your money tomorrow. Or you might want to take some of it and diversify it out into a larger firm with a better balance sheet. I just, this is up in the air right now. You can always put it back. If you have cash in there, I would take it out. Stocks are a little tougher to transfer. You don't necessarily want to buy, sell and buy back at another firm, but you got to look at that yourself. And Schwab was at the top of the list in terms of its unrealized losses, which is what put in Silvergate, because they actually pulled the trigger on that and took the $1.8 billion loss, which caused a lot of problems. Schwab may not have to do anything. They might be fine, but I don't know. When these things start running and the bank runs occur, there's, whoever's out the door first. I saw Peter Thiel's Founders Fund not only took all of their capital out of Silicon Valley Bank, they also advised their portfolio companies to do so on Wednesday, Thursday. So they were shrewd as can be, and but they've got all their money. A lot of people are going to be up in the air with this, including companies like Roku that have tens of millions of dollars of cash sitting at Silicon Valley Bank. They might not be able to get back. It's a problem. So let's hope for the best there, but prepare for the worst. And you should be shrewd as well. If watch over your capital. I've got a lot of my operating accounts go through Chase. If they go down, the whole thing comes down. But I'm going to be watching very closely this week what everything looks like in various areas. I'm going to look at different accounts and find out who's well capitalized and who's not. And if any red flags come up, I'll make adjustments. It's this is a very dangerous time. A lot of things are blowing up and breaking in this rate rising environment now for going on a year and a half. This is interesting. And I think it will lead to possibly a final capitulation in the miners back to their lows that we saw in 2022. We might retest. I think that's probably a good thing to prepare for. It's not that far below here, but it is something that could happen that would really set up a real bull market, weeks away, days to weeks away. I think that's where we're at with the miners, even though the short-term charts look ugly. Zoom back in the decade chart, the 10-year chart. things look very, very good. So I am very bullish, and I think being prepared and buying, buying these things into any weakness is a great idea. I'm going to stop that share. And this is, I just pulled up one of my newsletters that had made some comments about this as well. And so I'm just absorbing information. I'll be back to you this week with anything that's, meriting quick action. I am watching things and taking action. But I think, it's a great chance to build positions in the mining companies, because I'll give you a more detailed update from what I have experienced at the biggest mining conference in the world last week, and talking to a lot of people in the sector. It's really interesting. There's a very big paradox going on, how these stocks are acting, which is terrible, and they're trading very low historically versus gold, versus a lot of commodities. And there's a massive opportunity there. And a lot of us are very excited about what we see with talks in the background, and other companies that are going to have to come to us and secure their supply. Have a good week.